Good morning, good afternoon, good evening. This is Andrew Turner, founder and host of the G&T Sessions podcast. And today we have Mr. James Church. Hi, James. How are you?
Hi. Yeah, I'm good. Thanks for having me.
No problem at all. It's great to see you. And we're going to be talking about a very interesting topic today, which is about, well, you know, as we talk about in this show, we talk to an audience of, well, different people across the world who want to get involved in this whole topic of growth and technology, sometimes other products and other services, but also with gifted and talented people. So, you know, I'm honored to have James on the show today because he's got some really, really interesting insights. And I know that actually the little sneaky question, there's something over his right shoulder which seems to be attached to the wall, which might give people a bit of a clue. It's something that's green. So yeah. we'll reveal that in a second. So welcome to the show, James, and thanks for coming on the show. And so in terms of kicking off today's show, I know that you are a very prolific and published author.
Yes.
So
well, I mean, prolific. That's how you might describe it.
Yeah. Well, I have read your book, so you know I can actually put it out there as put it out there boldly.
Fantastic, thank you. So I'm the author of a book called Investable Entrepreneur, which it's an Amazon bestseller. Was a finalist for Business Book of the Year in the year that it was launched, and yes, it seems to have gone down pretty well.
And that's the thing that's hanging over your right shoulder, I think.
It's the thing that's hanging over my right shoulder. Perfect little bit of product placement, just
exactly. I mean, actually, it's nearly the same color as the G&T Sessions brand design. You see, so we're getting yeah. So maybe we have to make my green more like your green, and then who knows what could happen in the future. So I suppose you're getting into it. I mean, what in terms of that book? I mean, there was obviously we'll get into your background and stuff though. But what was the trigger for writing the book in the first place? Because obviously, writing a book is a big endeavor. Not an easy thing to do. What was the trigger for that?
Yeah. So I think really it came down to being asked the same questions again and again by founders we were working with. And these were what I felt were sort of fairly baseline questions. And it was clear, despite there being some great books that everyone was reading around how to build a startup, how to develop a product like Lean Startup and those types of books.
Eric Ries, yeah.
There was never really, there didn't seem to be one single resource that then said, well, okay, we've got this Lean Startup, we've built this MVP, how do we go and get funding for it? And when you looked at whether that be a founder who was a multiple entrepreneur, but maybe this was their first time building a business that required funding, or whether it be a founder who it was their first time building a business and needed funding for it, or even whether it was someone who had studied business at university and had a master's or whatever in business. No one seemed to know kind of the ins and outs of how to prepare themselves for a funding round. It seemed to be this sort of mysterious area, and there was
this dark art kind of thing.
Dark art, yeah, and there seemed to be lots of kind of miscommunication, or maybe not miscommunication, but varied opinions on the internet. There was advice from advisors and from VCs and from angels, and they all had their own sort of take on it. So I just kind of wanted to create one resource that kind of answered all the questions that I was getting all the time, and in doing so, kind of support the wider the wider kind of ecosystem. Because my business is a investment readiness agency. We help founders with their business plans, their financials, their pitch for investment. Well, we can only work with so many founders. We can't, we're a consultancy. We have limited capacity. I wanted to be able to do something that had bigger scale and bigger impact. So the book was a way of answering those questions, supporting people who came directly into me with these questions and kind of go, well, just read the book because it's all in there. And also support a wider community that I wouldn't be able to get access to on an individual basis. So that was really the focus. And I kind of challenged myself when I wrote it that I wanted to support kind of 100,000 founders through the process of writing this book. That was the kind of vision, if you like.
That was the BHAG.
Yeah. So I don't know where I'm at on that, to be honest. Now that I could probably calculate it and work it out. Probably not. We made a bit of a dent in that, but we continue to work towards that goal and just sort of support as many founders as possible through this, learn this dark art, as you put it.
Yeah, I mean, it's interesting because I mean I've read the book and it's very good. It's very good. It's like I would call it like a reference guide. It's like a checklist to challenge people's thinking. Because I think you can read probably, I don't know, tens and tens of books, but actually what you've done is I think you consolidate it into one kind of quite compact guide that can help people to kind of work their way through it and ask some challenging questions. And I think especially on the investor side, because I think some people who've not worked with venture capital firms or angel investors or whatever, then they don't really understand what's in their mind, what's in their head. About what are they thinking, how do they look at it? And I think you've got a really great. I wouldn't say it's like the book, like entrepreneurs are from Venus and investors are from Mars. But the way you articulate it, there is obviously sometimes they're coming at it from different perspectives.
Yeah, I think that was the key. That was the key that unlocked the book. Really was and the results and everything we do at Robot Mascot. I come from a brand communication background, not an investment background. So me and my co-founder, or the founder of Robot Mascot, Nick, we came at this very much from a perspective of we can see this clear divide between these two people that should be working well together. And it is a bit like that from Venus and Mars. Like founders think very different things are important to investors. Founders love their idea and they love to talk about possibilities and opportunities, whereas while those things are important to the average investor, they also care about risks and assets and proof and implementation. And very few founders get up in the morning going, what am I going to do to kind of really move my business on today? I'm going to do a risk analysis. It's not normally the thing that founders get excited.
It's not the sexiest thing that they're going to do, is it?
It's not the sexiest thing, is it? So seeing this clear divide between what investors wanted and what founders were offering was kind of the breakthrough moment for us. And we wanted to, I wanted this book to kind of set that scene and kind of say, look, you need to create these pitch materials, not to make you think your idea is great, but to make this an investment opportunity for an investor that has all these questions that need answering, and currently you're just not answering them. So you need to rethink the way that you communicate those things. So we really looked at it as kind of going, this is a marketing campaign to sell a product, and that product happens to be your shares, and the target audience happens to be the investor. How do we create pitch materials and forecasts and business plans that act like sales collateral for the sale of those shares? And once, because that was our background, we were able to write about it in that way and talk about it in that way, rather than an ex-VC talking about what they want to hear in an investor pitch. We were able to take that slightly different perspective on it. That
you've got like a different lens on it, haven't you? So
that's it.
And it's interesting because I mean, like things, looking through some of the kind of the minor investor points, some of the stuff is very tangible and realistic. A business plan, financial projections, etc. But I think there's always that thing of because I talked about this on a recent episode of the G&T sessions about traction. What's the evidence of traction? Actually, is it a big enough market? And actually, but very interesting, the last one actually about from what capital you've actually deployed in the business so far, how efficient have you been and effective on doing that? Because that's usually probably an indication of how you operate as a founder or a co-founder, and how, if they provide funding to you, how you'll continue and expand using their capital, which I think that's a really great point, I think.
Yeah, I mean, traction means a lot of different things for a lot of investors, doesn't it? And no one can really put a finger on what that is, and it's very much a grey area, and founders get frustrated of the stock response, I suppose, of come back when you've got more traction. I like to think of it as that response is almost a nice way of of an investor saying, I don't quite believe you can make this happen yet. I don't really trust you with my capital yet. So go away, come back when you've made some more progress, and then I'll be able to have seen the difference. And you'll go, wow, you achieved that in the last 6 months. That actually you're higher in my estimations now. Like I'm getting all of these founders come to me. You just haven't done enough yet to prove to me that you are going to be a good custodian of my capital, basically. So that's what they really mean by traction. And what they really mean is they want to see progress. And the more you can do to the founder to show that you've made progress, it's not about hitting a certain user number or hitting a certain level of revenue. It's about showing progress. And when you think of it like that, it doesn't matter if you're pre-revenue, pre-product, post-revenue, whether you've got 1 million in revenue. Your job when it comes to traction is to show you've made progress, really good and sustained progress in a fairly short period of time, and that you've whatever capital or lack of capital you've had to date has been used really well to get to from point A to point B. And that's really, in essence, what investors are looking for. Not a particular, like when you hit a certain revenue milestone, when you hit a certain user base, I'm going to be interested in you.
Like a certain active customer base or whatever.
That's
or
it.
a certain well, I don't know. I suppose when you get into later stages, then things like ARR, annual recurring revenue, become more and more important. But
and
it depends what stage you're at.
Yeah, you have that data more readily available the later stage you are. But I think there's certainly with the early stage stuff, it's but even then it's progress. If you've taken 10 years to get to that ARR figure, it's very different than if you've taken 10 months. So again, progress and the speed of progress or the amount of progress that's been made in a
or if you chat GPT, you've got taken 10 hours or something.
And that's why they've got that ludicrous valuation, right? Because they achieved it in 10 hours, not 10 years.
So do you find, so when you then talk to these founders and co-founders now, do you find that they're at a certain stage? Is it mainly like earlier stage, like when they're bootstrapped and pre-seed seed, or is it later stage, or is it a bit of both?
Our focus as an agency is very much pre-seed, seed, and Series A. That's our sweet spot. That's what we're great at, and that's really the focus of the book is for founders in that kind of stage of development. That's really our niche and our skill set.
Right, it's a pretty big niche, but I know
it's not much of a niche.
Sorry,
it's not the smallest of niches, but it's the vast. It's the top of the funnel as well. When you look at kind of if you're going to provide investment support, there's the largest number of people seeking those rounds.
I was going to say, why do you think there's? I can't recall the definition of that. Why is there a pre-seed and a seed these days? Then, why? What's your take on that?
It's pretty arbitrary. Is my take on it. It's just a name given to. I don't know why. Because there's now, like you could look at it and there's people going, well, I've done a pre-seed and a seed. This isn't quite a traditional Series A, so we'll call this a bridge round, or we'll call this a pre-Series A.
Or a post-seed.
It's just a name given to funding prior to institutional money, which then kicks off the Series A onwards. And the trouble is that things cost more now to produce, I think is the reality. Like 10 years ago, we were building e-commerce platforms. That was kind of or 15, 20 years ago, it was e-commerce platforms, and they were, they're relatively easy to build. Now we're talking about deep tech, AI, blockchain, machine learning. These things take more money to get off the ground. So then they had to kind of invent this kind of pre-seed and kind of go, well, we're not quite at seed. We need this initial capital.
Right.
Pre-seed.
Okay. Yeah.
And
yeah.
now
Okay.
we're getting to a point
sense.
where it's even more costly to get to that first kind of revenue generating, ready for Series A and institutional money. So now we're starting to see bridge rounds and post-seed, pre-Series A, whatever you want to call them, and they're just arbitrary terms. As long as it could just be round 1, 2, 3, 4.
Well, I mean, there's a really good table that if anybody listening to this episode, that if you get a copy of the book from James, it's obviously it's a point in time, but it shows you. It's very interesting. It shows you not only the stage, but also probably the range of investment you would get, and also the amount of equity you would be selling, or diluting into that investor, and also some kind of range on valuation, post money valuation, which is quite good.
That's a great kind of general rule of thumb that's there in the book, and then it can get more. Every business is different and need different amounts of capital, and needs someone building a platform, a fairly simple platform, is going to be pre-seed and seed is going to have a different definition to them than someone building a piece of med tech that needs maybe a huge amount of clinical testing before it can go live. So and therefore would have 3-4 years of just R&D before it could even start to make money. So it's a good guide, and as a general rule, pre-seed for me means pre-product, pre-revenue. Seed means I've got early stage revenues and a very basic version of my product in the market, and I'm looking to raise some money to kick this forward to a decent revenue generating, getting towards an 80k a month revenue, so $1 million a year. And then I can go and raise my Series A. So there's a general rule, but very few startups play by general rules. That's why they're disruptive, right? So it's sort of self-defeating in a way.
Yeah, I mean, I suppose what you're saying there is it's the cost of entry to their particular target market does vary depending on whether it's. I mean, if it's software and hardware in a tech context, then it's going to be a larger burn rate, you could say. That's a more significant investment request.
Yeah, that's it.
I mean, in terms of the filling on from the pitch piece. It's one of the things I think it was very interesting to see was about when you're constructing or trying to convince the investor to kind of get involved with you as part of that journey. I love the first point. It was like de-risk the investment, because I think one of the things I've noticed when I've worked in Silicon Valley and obviously in Europe and Asia as well, and you do have a different appetite for investment. I think you call it a different risk. I think you call it risk adverse or risk appetite, I think, in the book itself. Why do you think that there is that? The
difference between the US and UK?
Well, US and just non-US, I suppose.
Europe, non-US, yeah. As a general rule, research that I've seen, and I can't remember where I saw it, if I'm honest, but basically, in the UK, we're more driven by the city. And the financial markets and sector. That's a big part of the UK economy, and therefore the investors into startups tend to be more driven by the financial sector, and they're used to investing in stocks and shares and established businesses, and they do much more risk analysis, and they do much more, and they can't. Most of our investors come from that world, or that kind of their management accountants, or they're kind of finance people, or they're operational people that are used to investing millions of pounds into an internal project at a corporate. And now they're coming into this investment world, and they kind of have that same way of treating an investment, and they want to see all of the detail, and they want to get over the numbers, and they want to really understand the strategy and the implementation plans. And I read somewhere it's about 80% of UK investors kind of match that kind of term. 20% are ex-founders.
Right.
In the US, it's looking at sort of Silicon Valley, it kind of flipped on its head. 80% of investors are ex-entrepreneurs who have made a load of money exiting a business, and they're reinvesting it back into startups. So they're looking more at what a term that's become more prevalent, founder market fit rather than product market fit. And they're kind of going, you're a great founder or a great founding team. I'm investing in you. This idea will probably not take off, but I believe in you being able to pivot and change and adapt. And there's something here, and you're going to make something happen. And that's their attitude for that early seed stage funding. And that seems to be the reason behind those different kind of mindsets. There's also a very different culturally. There's a very different attitude towards failure. In the States, when you speak to anyone, whether that be founder or investor in the States, it's kind of like, this failure just means I'm one step closer to the success. Whereas in the US, in the UK and Europe, it's more kind of, you don't talk about failure. You always present everything as a success. You try and find a way to flip it. And we hate to talk about the idea of failing, whereas they're much more open about it typically in the States. So it's that kind of cultural divide. That kind of that's just the background.
Is it British stiff upper lip?
That's it. And yeah, I think I often say that we're just more British about it. That's ultimately it. We're just more British about it. And therefore, as a founder trying to raise investment in Europe, you have to be aware that it's not just, you can read all these stories about Silicon Valley startups raising all this money and how they did it off of a pitch deck or a 10-slide pitch deck or a coffee meeting.
They did it in an elevator. Yeah.
In an elevator pitch. It just doesn't happen like that in Europe because of the nature and the background of our investors and the cultural attitude to risk. And you have to be much more prepared across your business plan, your financials and your pitch materials to actually even get a meeting, let alone secure the capital.
But I think that's probably changed in the US, I think, in the last, N number of months, hasn't it? I think as we go into this kind of 2023 year, after a few fun years, are you seeing that changing as well? Even
definitely. So I was speaking to a US founder just 3 weeks ago, and he was speaking to me. He was seeking our support for his fundraise because he was an exited founder. 18 months to 2 years ago, he raised a $10 million seed round with no pitch deck, no financials, no business plan, just a conversation about his blockchain product. And he raised that money, and he managed to negotiate an early exit as well, and he's now exited that business. So here's a founder who's an exited founder with a $10 million round under his belt, and he's now launching a new blockchain product, and he's seeking investment for it, and he's suddenly hit a brick wall, and he's like, no one wants to talk to me. No one's investing in me off of the back of my conversation. Like, I need all of the stuff you talk about, James. I need to be more prepared than ever, because now I'm being judged. I feel like I'm being judged as a founder, and whether or not I can actually execute on this vision. And it's not the idea that's being judged. And 18 months ago, it was right. I didn't realize it at the time, but I'd hit the market at the perfect time when it was a big boom period. I had a technology that was like the craze, and you just had to mention blockchain to someone in Silicon Valley and they'd throw money at you. And I'm not getting that now. I need to be much more prepared. They're asking for all of this due diligence, all of these financials, and I've raised 10 million and never put anything like that together before. So massive shift in quite a short amount of time in terms of that attitude. So they are becoming more like the European investors. It seems. That's one anecdote, but so we can't.
No, I mean, I agree with the sentiment. I think it's kind of like a wake up call, isn't it?
Absolutely.
I'm not saying the US approach or the non-US approach is right or wrong. It's just it's different, and as the economies go through cycles, then surprisingly enough, the amount of scrutiny and due diligence increases or alleviates.
That's it.
I mean, it's interesting. It's very interesting. I mean, in terms of your background, I mean, you mentioned about the business that you're running. Did you find that does this apply to? Obviously, we talked a bit about tech companies. Obviously, you're on the G&T Sessions podcast, so we also talk a bit about tech. But do you see that the same process and approach and questions and steps you go through? Does it apply to non-tech companies as well? Would you say?
Yeah, as a general rule, I would say so. There's obviously, the product, the due diligence around the product itself obviously would change. So it's obviously tech products. It's going to be, a lot's going to be focused on the IP, the tech stack, the defensibility of the technology. Whereas
the IP,
if you're a restaurant, it's not going to be there, but it's going to be more about your processes and your systems and kind of how do you get the orders out and how can you scale that up? How can you, if you're expanding from restaurant 1 to restaurant 2, 3, and 4 over the next 18 months, what are your systems and processes to lift and shift that model into a new location? So there's kind of similarities, but they're just looking at different areas across that due diligence. But, the general kind of strategy for success, the understanding of the financial performance and how we get from A to B, where we are now, to where we need to be to provide investors a good exit, understanding what that financial vision needs to be for the investors to get the returns they're looking for, rather than just your own personal vision of, serving however many clients or having X number of restaurants or whatever it may be, or so many users. It needs to be focused on those investor returns. All of those things still play a part doesn't matter whether you're a tech investor or a tech business or a non-tech business seeking funding, that the principles in the book that I talk about are fundamentally the same. It's just the detail around them that changes.
And just while we're on that topic, why did you call the business Robot Mascot? I wasn't sure if that was because it was related to tech. Before you did this stuff, it was tech related, or because obviously robots are pretty popular these days and getting more popular.
Yeah, so it's 10 years old.
With the Boston Dynamics outfit, the coordinated dog training that's done with 1,000 robots in one room.
That's it. Well, we've got to thank my co-founder for that, because he's the creative. He's ex sort of brand and advertising maestro that worked for top 10 brand agencies. Does a lot of work on the Robot Mascot brand. So it's his brainchild. He looked at it and kind of said, we knew as a business, we always wanted to work with kind of future thinkers, innovators. We call them pioneers is the name for our audience. And Robot was very much a connection to that. It was about the future.
Right.
But when you think about robots in films, they're often the enemy. They take over the world. You think of The Matrix and how you ended up in a world where you've been taken over by robots. So it can be quite a cold term and quite a impersonal term, because it's taking away that personal.
You mean I suppose it's like Terminator and
exactly.
The Hollywood interpretation of it is the kind of.
So robot can sometimes have negative connotations. And the other key part of our brand and our persona and our philosophy was to be supportive. We really wanted to support the entrepreneurial community. We wanted to be the guide. We wanted to be the friend and the ally of the founder. So the mascot kind of softened the robot. It kind of nods to us wanting to be the friends and the allies, the biggest supporters, the biggest fans of our clients. We're their mascots. And the two words kind of sounded well together. It was really memorable. We're either you're the robot guys or they remember Robot Mascot because it's quite distinctive. So it just kind of stuck, and it just felt like it really encapsulated what we stood for in terms of being pioneers and future, or working with pioneers and future thinkers, but also being their biggest fans and being their supporters and being.
It's also like being a Sherpa, isn't it? It's a bit like you go in an analogy of you going up a mountain and you're a Sherpa. You're kind of guiding them up the mountains and base camps at the top.
We use internally when we were kind of doing this brand discovery, and even still when we're talking to our team, is a shorthand for that is to say we're the Yoda for startups. We're not the hero. We're not Luke Skywalker. We're not obviously the enemy. We're the Yoda. We're the guide that helps them overcome that obstacle and ultimately win the day.
So you have to put all the words in your sentences backwards, then, won't you?
Yeah. Not great for communication, is it? Which is our key skill set. But yeah, it was that idea that we're that guide, we're the Yoda of the outfit. We're not the hero of the story. We're the founders we work with are the heroes. The obstacle is getting investment, and we're that guide character in the story.
No, that's cool. I like that. It's good that. I mean, in terms of you personally, I mean, how did you fall into this area then? Were you always in this kind of branding, marketing sector, or did you kind of just? Is it something that? Did you start as a certain role, and then you pivoted into kind of, or you changed your career into this area? Or?
Yeah, so it's been a bit of a journey. So I started in graphic design. So my degree is in graphic design, and I started working at brand and advertising agencies as a designer. That's where I met my business partner, Nick. He was a creative director at those agencies. We had a really good rapport, good working relationship together. And then we wanted to start our own agency, our own brand agency. And that's how Robot Mascot started life. We were focusing on brand communication. That was really our focus. And one thing led to another. And eventually we ended up in a situation where we were working with these kind of pioneers, these startups we wanted to work with that were innovating, doing things differently, that were exciting clients. And by doing their brand comms, we ended up being asked to do their pitch decks. And we didn't really know anything about pitching for investment or pitch decks, but we were a small little startup agency, and we just said yes to any work that would come our way. But then we had to figure out what a pitch deck is. So we did a quick bit of research, and we started putting these pitch decks together, and our clients were getting good results from them. Our advisors, who happened to be angel investors as well, saw the work and was like, this is really good. If only every pitch deck that landed in my inbox looked like the ones you've just produced for these clients, you might have something here. You might want to see if there's a niche there to focus this, full service brand communication agency down into something more niche. So we went to various events, and me and my business partner kind of built up this understanding of, and we identified this communication barrier that we covered already. And yeah, one thing led to another. And eventually we kind of pivoted, focused, niche down into this one space, did hundreds of hours of research with both investors and founders. And ultimately all of that research ended up in the book as the book. And we, once that book was launched, we completely niched. We dropped all of the brand services, and 100% of the business was around investor communication and preparing founders ready for investment. So yeah, it's been quite a journey from kind of graphic designer through to kind of what we do now, but absolutely love it.
Yeah, it's interesting because, the reason I asked was because if you look at the principles you put in about, when you get that perfect pitch deck, design is step 6 and there's 5 other steps, which are kind of like, you would say are not, well, I suppose a bit of them are like content, but quite a few of them are non-really the kind of inputs into the final design, but they're not actually the design. So
yeah,
that sounds like a big education process, I suppose, that you've had to go through as a team to work out how you guide people through the process, I suppose. Now
that's it. It was very deliberate, and that's because we used to get a lot of people coming and saying, "I need you to help design my pitch deck." And when we looked at it, it was like, we don't. We need you. Firstly, we need to help you better communicate your business case. And then, so then we were sort of doing work with founders, and we were kind of saying, right, send us your business plan and your forecasts, and we'll help you better communicate your business case, and we'll write the copy and the content, and then we'll design it. How many founders were we speaking to could send us business plan forecasts? Probably 1% of them. I haven't got anything to send you. I've got this idea. So then we were like, okay, we need to take an even further step back, and we need to help you prepare for this and we need to write the business plan, understand the business case. We need to produce the forecasts in a way that investors can understand them. So then we can write the pitch content, and then we can design it. So what started as, can you design my pitch deck? When we kind of said, send us the information we need to do that, they didn't have it, and we had to keep working our way back to really help them get the result. We could have just designed something, but it wouldn't have gotten the result.
Why do you think there's a gap then? Why do you find that there was a gap with the founders and co-founders you were talking to? Why did they not have that prepared? Because there was a gap in their education, or there's a gap in the
or perhaps it's the kind of media, the stories, the blog posts about these sensational rounds of investment. The only investments that you really hear about that are popularized through blog posts and news articles are, the founder that sat, the literal elevator pitch where he pitched someone in an elevator and he got the funding, or sat down in a restaurant for 30 minutes, or got picked up by an angel investor, jumped in their car, did a 30-minute drive to their next meeting, and ended up with it's all of those kinds of stories.
It's like the glamour around it.
Glamour. And I think, most people's reference point for investment is either that or Dragon's Den or Shark Tank, depending on which country they're in. So they're their only 2 reference points for how this works. So I think there's a massive misunderstanding of what's involved. And I think many founders start with that viewpoint of, I've got this great idea, I need to go find some investors that will give me some money to do this. How do I pitch them? I need a pitch. And actually,
I suppose the other thing
that goes into the pitch to give it credibility.
Yeah, I suppose the other thing I was just thinking about was probably things like Y Combinator and Techstars and obviously other accelerators that people can go into. But I suppose then you get into that kind of which is similar. I suppose you could say is a similar process to what you articulated in the book.
Kind of. There's obviously focuses more on not just raising the investment part, but the kind of building the product and market validation and all of those things. But even to get into them, like we've had clients come to us to build these funding assets to use them to apply for Y Combinator.
Oh, right.
Because that's highly competitive.
Totally, totally.
they're treating it like an early stage investment. Their decision making as to who they take onto their accelerator is almost identical in terms of the decision making that an early stage pre-seed seed angel investor might go through.
Yeah, I agree.
They're going back. So even for those accelerators, the top ones, again, there's probably an assumption amongst founders that, you know, as long as you've got a cracking idea, they're bound to let me into this accelerator. They're bound. Why wouldn't they? This idea is amazing. And actually, 20% of it comes down to the idea. 80% is how are you going to build it? What's the implementation strategy? Do you is the market big enough to get sizable returns? Do you even know what that looks like? You know, how have you plotted your route to success? How can I trust you with my capital? And that's the bit that founders aren't necessarily focusing on. They're focusing on their idea. And there's a phrase I use in the book and in nearly every presentation that I do, and that's great ideas don't raise investment. Great communication does. And you really need to communicate the concept, the vision, but also the strategy and the insights that have led to this point. If you're going to raise investment, it's not about your idea.
Well, there's a very interesting stat that I know you start early on in the book about, you know, one in 100. Yeah. Do you think that's getting better, or is it getting worse, or is it still the same as we're in this, you know, in this sexy, you know, the people who now feel that tech is sexy.
Yeah, more or less the same.
And magnetic.
More or less the same, because what seems to have happened is the amount of capital has been going up year on year, and there's been record-breaking years. Even we now, like 2022 was a record-breaking year for early stage investments across Europe. So whether it's late stage or early stage, there seems to be an upward trend in the amount of money being invested. An abundance
of capital,
which might make you think it would get easier, but equally there's more startups starting up. So I surveyed my network and on LinkedIn, and 86% of them responded to a poll saying that they were planning on raising investment this year. So there's a huge number of founders seeking that capital. So while there's an upward trend on the amount of money being invested, there's also an upward trend in the number of founders seeking that capital. So we tend to see, give or take a few, you know, point something percentage points here and there. The 1% figure generally,
but it's nowhere near double digit though, is it?
In terms of
what I'm saying is, if there's 100 founders, the market stat is it's 1 to 2%.
1 in 100. You're in a race. You know, it's like you're on a 100-meter sprint and you're lined up against 100 other founders, and there's a stack of cash at the end, and it's only the founder in the best shape, with all of the things we've talked about today in place at the best of their ability, is the one that's going to ultimately win that race. But so every time you send a pitch deck to an investor, you've got to imagine yourself on that starting block against 100 of your peers, and you've got to be the one that gets to the end the quickest, and has to be in the best shape. And when you imagine it as a physical race of 100 against 100 people, suddenly you realize, am I the Usain Bolt of this? Can I be?
I was just going to say Usain Bolt.
Yeah. Like, can I genuinely send this pitch to this investor believing that out of these 100 people that I'm lined up against, I'm a shoo-in for the gold medal? And unless you feel confident enough that you could win that race, you probably shouldn't be sending your pitch to them yet. You should probably take a step back.
It's like that film, isn't it? So you're either Usain Bolt or you actually are the Jamaican bobsleigh team, that.
Yeah, it's like, they gave it their best shot. Bless them for trying. I don't think any founder wants that to be the reaction when they send out their pitch. They don't, they want to be the Usain Bolt, and unless they genuinely believe they are. And think that Usain Bolt's lined up against 10 people, not 100. So you've got to imagine that on 10 times the scale.
Well, by the way, I'm going to ask you. I love the little story about Mick. By the way, your father-in-law.
Yeah.
So take your as an analogy to an investor when you go to the car auctions for Austin Healey's.
Yes.
Could you explain that little story to the audience?
Yeah. So I just noticed that going to these. So my father-in-law is a massive fan of classic cars, and I noticed I used to go to some auctions with him to have a look at these cars, and I noticed that the process he'd go through was remarkably similar to that of an investor. And I thought, we all buy cars, we probably all understand what buying a classic car auction is. So this might resonate with some people. But the first thing he'd do is check the listings on the website, check the listings on the of what was coming up at the auction, and he'd be looking for specific things that made the perfect investment for him. So certain type of car, certain make, certain model, certain engine size, you know, those types of top level things. And there would be some lovely cars, but they just weren't for him. They're just not his style. They're not what he likes. And equally, there'd be a younger audience at the auction who were buying like 1980s classic cars, because they're apparently classic cars now, just to make everyone over the age of 30 feel old. But there's like 18, 19-year-olds buying these 80s cars that they, for them, are classic cars, and for us are a bit of junk, right? That we remember growing up. So
speak for yourself, James.
so it's people have different viewpoints, right, on what is good and what is right for them, and that's the first thing, is that when you send your pitch to an investor, just because they say no doesn't mean that it's because your business idea or concept or your strategy is wrong. It's just not the right fit for them. Nine out of 10 times it's just not the right fit for them. It's just not, you know, they're not looking for a Ford Mustang, they're looking for an Austin Healey. That's what they're just not the right fit. The next thing he'd do is he'd kind of visit the auction. He'd have his short list of cars that ticked his criteria, and then he'd go and look for credibility. Do they match up to the listing? Are they as good as they look? Or are they just, they just got really good photos and they're not as good as they look? So he'd have little tricks and tricks that he would use to really understand the investment he was making in this purchase of this car. So he'd do things like lift up the carpet in the boot of these classic cars, because he knew that if there was rust in the metalwork under the carpet boot, there was almost certainly
the chassis gone.
Yeah, you couldn't easily see. He'd tap around the car, like knocking on the metalwork, and it was something like dink if it was original metalwork, donk if it is full of filler, and therefore the car was rusted and put back together with filler. So he had these little tricks, and investors are doing the same thing when they analyze your business plan and your financials. They've got tricks that they use to determine whether or not you as a founder can be trusted with their money. They're looking for certain ratios, certain metrics, certain progress to be made, as we've kind of talked about earlier. And then the final thing he would do, he would so that was them checking for consistency, right? Consistency with the listing. So you've sent this pitch, it ticks my checklist of requirements. Now I'm doing some due diligence. Is this all it's promised to be? Is it consistent with that original pitch? When I look at the detail, it's the founder got everything in place. And then the final thing he'd be looking for is credibility. So he'd go and find the owners of these cars that were selling them, and he'd try and discover certain information. He'd ask them questions. He'd see whether there was certain paperworks in place, whether they had any records of services. Were the replacement parts original parts and genuine, or were they kind of newer, more modern parts that had been used to replace? All of these kind of questions. And again, investors are doing the same thing. They've got to a point where they've looked through your business plan, your financials, and your pitch, and they're like, everything stacks up. But now I need to interview the founder and really understand their motivations. Do they understand this? Do they understand the direction of travel? Is there the credibility there in these materials, in this founding team, and in this business, to give me the trust that I can invest my capital into their business? So it's remarkably similar to the process we might go through to buy anything. Like, you could imagine that process being the same for if you were to buy any high value item, if you were purchasing a house, or you would do all these things as a consumer when you go and purchase a really high value item. We just need to think of this as a sales process, just like buying anything personally. So that was.
I think that's you're highlighting there at the end is about that. Maybe not every founder has been exposed to sales and a sales process, so they're learning about that as well, and they're going to refine that skill. They're going to improve their skill over time, the number of sessions they go into, and you're very, very lucky if I've known founders that have done hundreds of pitches before you got to the one that actually you win the hearts and minds of that investor or investors. So it's not a kind of a slam dunk basketball in the net in one go.
No.
Which links to another point I think, which is really great. Is it triggered me. So you said there's some kind of characteristics of founders or people that are kind of starting on their journey. That hero in that journey was confidence, relentless, and conviction. And it made me think of Tim Grover. So Tim Grover wrote the book The Relentless, and I've been on a few sessions with him. He's a guy that that trained all the famous basketball players like Kobe Bryant and Michael Jordan. And he wrote a book called Relentless. So it's kind of, I think maybe all the founders should also read your book, and obviously also read The Relentless book.
Read that one, yeah. Yeah, absolutely. You need to be relentless. You have to have pure conviction, because you're going to get, like, based on the statistics, right? You're going to get 99 no's for every one yes that you get. Now, you can massively improve that conversion rate by executing and implementing some of the tips that I put out in the book. But you know, let's assume you're going to get 99 no's for every one yes, and perhaps you need 5 yeses to get the deal over the line, because you typically would need 3 to 5 angels to get a typical angel deal over the line. So you're going to get what does that work out? 495 no's and 5 yeses. So you're going to have to be completely relentless. They don't know what they don't know what they're talking about. I've got this. I know that it's just not the right fit for them. It's just not, you've got to have that complete conviction, that complete relentlessness to overcome those kind of, because it hurts, right? When you get a no.
Well, it's like a salesperson. You've got to also work out how do you handle objections, because they're going to have objections, aren't they? So in that way, it is a sales process, and you're going to have to talk to
one of the best things I was ever taught in sales is when I was first starting out as an entrepreneur, was that to treat every no as one step closer to the yes, to seek the no's, because the no's take up brain space of kind of, are they interested? Are they not? Let's put those on my list to get in touch with again, to see whether or not, and you get a slow no, which is people not saying no because they're brought up as a child that that's a bad thing to do. You don't reject people, you don't say no. So it's baked into our subconscious that it's not nice to say no, and be, and to kind of do that. So you want to train yourself to seek the no's and kind of go, look, be very upfront and open, make it okay.
Be a no-seeking missile. That's what you should be.
No-seeking missile, and just kind of make it okay to say no. If this isn't the right opportunity for you, I completely understand. I'd rather you just let me know so I can close the file on my end. We can, and I can move on to the next. Like, just be really open.
Well, that's the thing, isn't it? I mean, it's back to classic sales. It's, yes is great. No is not great, but maybe is like, the worst, because you never know whether it's a yes or a no.
Yeah. So you want to seek the no, and you'll then find the yeses. But at least if it's a no, you can park it. You don't have to worry about keeping in touch with that particular investor, keeping them up to date, kind of trying to convert them, thinking that they might be interested. And that overcoming objection point is a massive one. And you need to find a way at the end of your meetings with these investors to draw out those objections. And a great way to do that is to have kind of a physical expression of interest form. So we often give our clients an expression of interest form, and it's very simple, kind of, what's your name? How much might you invest in a round like this? What's your typical round size? Can you bring anything else to the table other than money? Are you looking for SCIS, EIS shares if you're a UK company? Those types of things, just top level questions. If you feel like the meeting's gone really well, ask them to fill that in. It's not legally committing them to anything. It's just a written expression.
Well, you're getting some feedback, aren't you, as well? You're getting some feedback.
One of two things will happen. They'll go, yeah, happy to fill that out and take the conversation forward. Or they'll go, oh, no, I'm not ready to fill that. Seems like too much of a commitment. It means nothing, right? But it feels, I'm putting something in writing, so this feels more official than my verbal commitment. Or I'm not quite ready to do that. Okay, what would you need from me to feel comfortable completing this form? Because this really helps us better manage our round. Oh, well, I'd need to understand X, Y, and Z first. Brilliant. I've got your objections. Now I can overcome them. And if you can treat it like this sales process, you're going to get so much further with your
I agree.
You're going to keep control of the round.
Cool. And I won't ask you to go through them, but there's some really good sources of investment. You go through all the different stages. It's interesting. So a previous guest actually came from Crowdcube. So Sean Sharkey, my good Liverpudlian supporter, came on the show a while ago and went through all the kind of pieces. I think he's not there anymore, but he's moved on to some other tech company, I think now. But that was a very entertaining episode with him, because obviously crowdfunding kind of, I suppose, especially in the UK, was kind of, I suppose, it was pioneered, you could say, with and all the stuff like Monzo and a few of the other very famous tech companies got kind of incubated and supported through that process, didn't they? So it's good to know about that. But there's also stuff like family offices and VCs, private equity firms, obviously brokers and stuff like that. So there's obviously a few other avenues you can go down.
Yeah, and I think crowdfunding is one of the most popular. But obviously, there's loads of angels out there, and crowdfunding isn't for everyone. You need to have a decent network. You need to be able to promote this. You're talking to retail investors that invest lots of small amounts, so you end up with hundreds of investors all investing a small amount, and it's not right for everyone. And I have had founders kind of ring me up frustratedly, kind of their rounds on Crowdcube, and they're like, honestly, I was having so many questions from this one potential investor, and I was answering them, and I thought, wow, this person is going to put so much into this round, because they're asking all of these really insightful and detailed questions. They ended up putting a tenner into the round, because for this person, £10 was a really important decision. You don't know their background. They're a retail investor on this platform, but they're asking all these questions, and you think they're a serious investor, but they put a tenner into the round. So it can feel a little bit kind of you're having to service hundreds of people with all that demand. Yeah. Versus an angel round where you might be seeking, you'll get lows and no's, but you'll be seeking 3 or 4 checks that are much more valuable from a few people. And it can be, for some founders, it can be really strategically beneficial, because ideally this is smart money, and these angels can bring more than capital, and they've got connections and strategic insight and stuff that can really pull your business towards its next kind of round, where it goes on to sort of venture capital funds and that kind of thing. So crowdfunding's you do so well in those early stages that you actually create such an amazing balance sheet. You don't take any more funding at all. Well, what about that as an outcome? Yeah, wouldn't that be amazing?
Well, let's pray. Let's pray for those founders that can achieve that in the future.
Yeah, and there's some that do, but it's become the rarity to do one round of funding and reach profitability and scale these days. Like we said earlier, because of the sheer costs involved in building the tech before then having to achieve the scale.
Yeah, I mean, I suppose that's the scenario. Most businesses are now having to think about tech and how it becomes part of their operating model. And everybody, what's the Mark Andreessen quote? Every company is a software company. It's all that kind of thing. It's that kind of theme. I suppose just one classic little nugget actually I wasn't aware of actually, was when you talk about design. I didn't realize it was actually Florence Nightingale seemed to have a really big impact on design with her. Is it Rose Design? I think
Rose Diagram.
Rose Diagram. So that's right. Yeah.
Yeah. So I talk about how the power of design and looking at the way design has influenced people in terms of presentations. And obviously there's I think it's Playfair I talk about in the book, who kind of invented the pie chart and the way to present statistical data. But what Florence Nightingale did is she presented a story using charts, diagrams, design to really showcase her desire to have the British Army invest better in medical conditions for the army, because she was able to present through the use of her Rose diagram how many soldiers were dying on the front lines versus how many were dying in the medical camps behind the front lines. And it was a multitude of, I don't know, however many X. But by using design to present this information alongside an emotive narrative, really kind of changed the way that we looked at how to present data, and was kind of one of the first infographics, if you like. That's
what I was just thinking actually, is it's like first version of infographic, first iteration. Yeah,
it was just, how can I get this? I've been telling them for years, but it wasn't until she presented it in a way that resonated visually and they could see for themselves the difference, that they then started to take notice. And
because he links back to that point you make as well about it's back to the point about, brain is very visual. You talk about being, dreaming in visuals, and then
dreaming in vision. We process like visual communication sort of thousands of times faster than written or spoken text. Because if you think about it, like Paleolithic cavemen, the first method of communication was visual. We would draw and etch things in the side of cave walls. We'd grunt at each other, and we would draw things on cave walls. And
that continued. And that continued with the Egyptians, and
it kind of turns out that these sketches weren't just what they saw. It wasn't just a picture of a mammoth, but they were communicating thoughts and feelings and ideas through these sketches. So these kind of crude kind of drawings on cave walls were kind of our first way of communicating. So it's no surprise that the human brains evolved to process imagery and design communication much quicker than spoken word. And if you were to just think of like a social media post or an image you saw on social media recently, you'd be able to recall it probably almost instantly, and you'd be able to tell me who was in the picture, what gender they were, what color their hair was, what clothes they were wearing, what location and setting they were in. Now imagine I asked you to write that out for me on a document, how long that would take you and how many words it would take to just that thing that's right in your mind right now. And it just goes to show how quickly we can get our message across if we were to do a little bit of thinking around how we present it rather than just what we want to say.
It's back to the old adage, isn't it? A picture paints 1,000 words. That's, it's absolutely spot on for that, isn't it?
Yeah.
So we're in 2023. I haven't delved into some of the questions that I would normally go into, like about peaks and valleys. It sounds like you've had just peaks all the time. It's like being going like that, But I mean, if you're going to share one valley in your journey so far, actually something that you planned that didn't quite work out, what would be that one thing that you wanted to share with the audience to kind of give them an inspiration that you're not a robot and you are human, and sometimes you do, some things don't work out quite right, and you learn from that.
No, there's been plenty of valleys, lots of them. I think that's the entrepreneur journey, but there's certainly been. In the early years, when we sort of launched as a brand agency, we didn't really have a focused niche. I think the best thing we ever did was niche and find this niche and this thing where we could have a real impact and have a different story to tell in a different way and kind of approach things differently. Because before that, we were just like any other brand agency that thought we were pretty good at what we did, and we didn't have really anything that differentiated us. And, there was times there where it was just me and my co-founder, and we were trying to get this business off the ground, and we weren't able to pay ourselves, and we had these tough times too. And that, to be honest, we got to a point where we were not really a business, but just two freelancers that just about earned enough to pay themselves. And that was our business for about 3 years. And we just struggled to really break through to it being kind of a partnership of two freelancers really into a business, and that was probably the valley for us, and that valley was a very long, deep valley before it came up the other side. And it was once we had the confidence, because the thought in that situation is, if I niche, I'm getting rid of all of this other opportunity. And the change in mindset for us was when we brought in a growth advisor who kind of explained a niche as nothing more than a campaign. You can change that campaign. There's this is what you do. The niche is the campaign, and it will radiate out like a pebble in the water. And that's what you'll focus on. And then other opportunities will come your way as a result of you focusing on that niche, but you'll have clear cut through in what you do. And it will, and we took that on board, and we niched into this. We had a few options, and we niched into the one we felt we could best serve, could achieve less scale. And that's when that big, long, deep valley turned into a peak, and it's been a growing peak now for the last sort of 3-4 years. But there was some really tough times.
You're on your way to Everest. Yeah,
we're getting there. So yeah, there's definitely these troughs, and every founder goes through them. It's just iterating.
It's back to then your three constructs of your founder, isn't it? About being resilient and relentless and confident and be committed to it. Fantastic. Thanks for sharing that. I appreciate it. I mean, in terms of your 2023, what are you most excited about this year then? Or what are you most excited about the future?
Yeah, to be honest, just seeing our team grow and flourish, like really sort of brought in this really solid unit around us that are absolutely thriving. And we spent the last year kind of what we kind of said was a consolidating year of kind of going from an agency that used quite a lot of freelancers to having a consolidated team. And that was very much our consolidation year. And moving forward, we're seeing that team really gel. We're seeing that thrive. And we're looking forward to kind of growing that team and growing that experience and being able to expand on that. I think that's what I'm most excited about.
That's a great one. That's great. Because it's, you kind of evolving the culture as well, and
that's
evolving. They kind of start to perform and outperform. Yeah,
massive learning curve as a founder of kind of bringing these people in internally now and having to manage culture and team dynamics and making sure everyone's working together in the right way. Massive learning curve, but an enjoyable one.
Cool. That's very good. So, so in terms of anybody who's listening to this episode today, I mean, they want to find out more. They want to get hold of that nugget of value, that value bomb from Mr. Church. What's the best way of getting hold of that? How do best go get hold of you as well?
The best thing to do is if you go to pitchready.co.uk. That will serve you with a short quiz where you can benchmark your current ability to raise investment. It will give you a score across 3 key sections and a report giving you tips and advice on how to improve that score. You'll also then get a link and an opportunity to download a copy of the book or order a copy of the book for free, depending on where you are in the world. So in the UK, you can order a physical copy to your door completely free as a result of going there. If you're outside
there you go.
If you're outside of the UK, there's an audio book, there's a PDF download available to you as well. So yeah, pitchready.co.uk is the best place to go, and then you can start getting all of this information to help you on that journey to raising investment.
Fantastic. Well, thank you so much for coming on the show today. It's been a fantastic session. We've packed a lot in that time.
Yeah, it was good.
So, but long form, I think long form is definitely better. And then we can do a bit of editing, and we can put some little value bombs out into the universe.
Absolutely.
So share the love.
No,
so thank you very much for coming on the show. That was James Church of Robot Mascot, co-founder and COO of Robot Mascot. And that was Andrew Turner, founder and host of the G&T Sessions podcast. So, see you next time. Bye-bye.